Welcome back to smarthelping.com. We've got a security system and alarm services recurring revenue business model here. It's for a 5-year startup. Now, this is also has very advanced logic for any recurring revenue service business, any SaaS business. You just have to zero out some of the installation revenue stuff and you can use it for that. The reason I say that is because I've added complex metrics in here, including expansion MRR, monthly recurring revenue, as well as negative churn rate. And that is one of the most sought after metrics to improve in a SaaS business. And we'll go over in detail how what it is and how it's displayed in this model. But um, we're gonna go through each tab. I'll explain all the assumptions, what's going on, how it works, and uh, and then you'll know what how to use it. So start with the control tab. This is going to have the start year of the model, and you'll always put in the first day of the year here. So 1/1/2020. If I was starting the business in 2021, I would put 1/1/2021. No matter what actual month I plan on revenue starting at. Then you got your exit month, which could be doesn't have to be the last month of the fifth year. It could be any month, and the model will automatically update accordingly. You've got an exit multiple, which is going to define the value of the exit, if any, and it's just based on the annual revenue of the business, annualized based on that month's revenue, and you get exit valuation. If you don't plan on selling or just plan on stopping the business completely and just leaving, then you can put 0 here. But for the purpose of investors and cash flow valuations, discounted cash flow, usually you'll have some exit value here. Then we've got some sources of cash. You've got debt, and there's actually that will pull right to the debt schedule, which you can define the other variables for that here, including the months you plan on that um, financing that, and then all the terms. Um, we've got investor equity, and this is if you're going to raise money from investors, the amount you raise, the percentage you're giving away of the business to them, and then it does an implied valuation based on that. And then the remaining equity, this is if you have if the resulting assumptions are such that you have to come up with more cash beyond the 1,500 here and the 250,000 of the loan, the remaining will come into here. And we'll get more into the distributions and contribution summary at the very end, but that is what that is. So let's say if you got in 2 million from the investors, you're not going to need any cash. So that means you've raised enough money so you don't have to put any of your own in, and um, that's the resulting valuation, and you're still getting 25% of the profits, even though you don't have to put any cash in. But there's all kinds of variation and strategy here that you can do, and you can play with all these variables. You can zero out everything. You can put these both at 0, and then you'd be coming up with all the cash. But then you obviously don't need to give any of the profits away. Um, you see in distributions in that case, the owner will get all of the cash flow, the free cash flow. But we're going to show the logic of if there are investors and debt and everything else, so you can see it works. Then you got your total debt and equity as just a resulting calculation from the above. So now we get into revenue, and so this is a uh, service security systems like cameras and alarms, motion sensors. There's all kinds of different recurring revenue subscription models. So what I did to try to fit the most and give the most flexibility is I just came up with 3 pricings here. So, you've got your low, mid, and high location. So a high location might, you know, whatever you put in here is a number. You could put this anything here. Um, but here I just have it at 85, then a mid is 45, and a low is 28. So a low would be like your standard um, subscription service, no add-ons or anything. A mid might have a couple add-ons, or just some variables that result in it being higher, and then high is again the same thing, more add-ons or just a higher monthly revenue that you're earning from those locations. And if we start at the top here, you can pick the start month of your revenue. So this is where if you plan on starting revenue in, let's say, not till May, and you're starting out with, you've got 5 locations already, and this could be 0. You see if we go to the monthly, it's going to have nothing happening until May. And then we've got the amount of locations added per month by year. So this is saying in year 1, you're adding 30 locations a month, year 2, 35. And again, you could put in assumptions for whatever your plan is here. Just got to fill it in. And this could be 0 to start with. It could be whatever number. Um, and then you define the amount of new locations added that fall into each monitoring service level. So this obviously always has to be added to 100%. So the last calculation can be a filler based on what you put for the low and the mid. And you could change these over time if you think you're going to add more mid-tier locations in the future than low or more high or whatever. You can adjust these however you want to plan it out over the course of 5 years. So that's location additions, the amount of locations of each type, the price per month that they're paying. Now we've got regular churn. So this is just churn of canceled um, contracts or canceled subscriptions. So let's say they every month about 1% of your customers in the low tier cancel, 0.5% of the mid tier, 0.5 of the high tier, and you could again put these at whatever you want, but that's just going to say in your monthly calculation here, it's this number right here. And the reason why we have decimals is because it's just an average and it's more accurate for the scaling to include decimals instead of rounding. So obviously you can't have 0.2 locations, but it just gives you an idea of what that looks like over a long period of time. If we go to margins of installs, so now we know, how much churn. So how many locations are you adding? How many are leaving per month? Now this is the part where it's specific to the security business or security and alarm services business, because you've got to have installations of these monitoring systems. You've got to buy, you've got labor to go and install it, and you've also got to buy the equipment. And so this shows you the percentage of locations that are low, mid, and high budgets. So that's different than actually, you could have a high budget that's actually paying a low monthly fee, but they're having really expensive equipment put in. So that does not tie directly to this. So that's why we have to add more percentages here. So this is just saying the amount of percentage of new locations that are low budget, mid budget, and high budget installations. And then we're going to get real advanced here. So look at we're trying to figure out the average cost of a low budget install. So you're going to have to estimate what the equipment cost is for a low, mid, and high. So you're going to have to research this and figure out, okay, if I'm installing a security system, it could be, residential is probably going to be on the lower end, and then commercial is going to be on the higher end. Um, but you're just going to define 3 ranges of costs here for the equipment. And then labor is going to be a fill-in or a calculation that's based on some variables here. So we've got the installations that a tech can do per month per installation type. So we say um, a low budget tech installer can do 7 installs a month, and the average install is 20 hours, and their hourly rate is 15. So then you can see this is how many hours per month per tech there are, and hours per week per tech, and then your total cost here for labor, which is just going to be the average hours per install times the rate. So this is like for doing 1 install, it should cost $300 in labor and $600 for equipment. And those will all change based on what you make these variables, which you can adjust to whatever you want. Like if I think a tech can do, um, if an installation costs 25 hours, or if the hours for installation is 25, then you can see the labor goes up a bit there and the total cost. Um, and then same exact thing for the mid and high budgets. You've got these, now I've got them going down because the idea is that um, this is a bigger job, so the techs that are doing these can't do as many per month. So we've got 2 here. And the reason why this is going to be important, the installs per tech per month, because we need to define how many techs actually are required to run this business. So we've got fillers here that show you based on those variables I just mentioned. It tells you the minimum requirement of installers you're going to need um, based on the hours, based on the installs a tech can do per month, and the amount of installations you're doing per month. So here it's 30 to start out in year 1. So you're doing 30 installs per month. You're going to need 7.6 techs on average, and here's your installs. You can see that sums up to 30. So it's 15 low budget, 12 mid, and that's just showing you you're going to need 2 techs that are doing only low budget, 4 that are doing mid, and 1.5 that are doing high. And again, the decimals here are for accuracy. Obviously, it's either going to be 1 or 2 here, but so we can do really accurate math and show values without having to round this how we're doing it here. And you see how that changes based on doing more installations per month. You're going to need more techs. All right, so that is definitely specific to this type of business. If you're just trying to do a SaaS forecast, all you do just zero all this stuff out. So this is irrelevant. You zero that out, and then if you go to monthly here, that's fine. You don't this calculation doesn't go anywhere, so it can be a div error, no worries. And you can see there's just no installation revenue, and all the recurring revenue is still there. And then you would also go to the cost tab. You zero out this. Oh wait, no. This is no. You don't want to zero out that. This is actually, we'll get into this in a second. This is for the cost of your monitoring service, which could be applicable to any SaaS business. It might not be. If not, then you can zero it out as well. Yeah, you would just zero that out by putting 100%. Here if you don't have a cost, and that's just basically saying it doesn't cost you anything directly to host whatever services you're hosting here. But let's get back to where we were. So text, all right, let's undo all of that so we have numbers back in there. And then, so this is going to allow you to define a margin that you're going to make on each installation. This is going to define how much installation revenue you're going to make. So you might be charging a markup on the equipment as well as the labor. This allows you to define the markup, or not the markup, but the margin you want to earn. And based on that, you charge an amount here. So you can see this is 45% for the mid. If we look at this, our cost is 8,000, and our revenue charge is 8,000. If we charge 8,000 less our cost of 4,500, that's 3,641. If you divide that by the amount you're charging in revenue of 8,000, you'll see the result will be 45%, which you can see it is right there. So that's the logic for all of those, and then this pulls into the monthly. This pulls into the monthly summary for installation revenue as we go down the line here, right here. So this will tell you how much installation revenue you've got. And maybe you just want to run it at break even, just to get more recurring revenues. Like you just want to get the equipment in there, you just charge at cost. You can just put a 0% margin on that, and this will just be exactly what your cost is. And you can obviously adjust these over time if you needed. The next assumption is huge, and this is for recurring revenue services. and we've got upsells and downsells. Now I don't have you going, you can't go from tier 1 to 3 or 3 to 1, but you can go from tier 1 getting upsold to tier 2, so you're getting more money from the same customers, and tier 2 to tier 3, so the same thing, you're getting more money with the same customer. But then you've also got potential for downgrade, so you've got people going from 3 to 2 and 2 to 1. And you can model that out here, and that's going to be your main driver of how you're going to see the expansion revenue and churn and negative churn. Basically, the goal is to have more revenue from the same customers compared to the revenue you've lost from downgrades and canceled clients. If you can get that, then you basically have negative churn, which means, well, it just means you're getting more revenue. You're actually increasing um, the revenue you're earning from the same customers. And this does not count additional revenue from new customers. So like that doesn't count these new customers here, 30 per month or 35 per month or 40. It's not counting the revenue from them. It's just counting the change of the current customers of that given month to do the calculation, which is a very advanced calculation, but super helpful and that's what any SaaS business or recurring revenue business wants to focus on, getting their churn to be net negative. And essentially it basically means you're gaining money every month um, from the customers that you have. Then we just have some basic logic here for average service calls per location per year. So this is gonna, like, you're gonna have to send techs out to do service calls, so that's that. You might charge for that, and then based on the hours per service call, there's gonna be some cost you have to the techs, which is gonna be defined on the cost tab. Um, so that's the revenue tab and related items. Now we've got costs. So I've already went over this. So this is showing you your monthly fee for the host or for the subscription service that you're charging for. So over here, you're charging the customer $28, $45, $85 a month, plus sales tax if applicable. And then you're paying a supplier of these monitoring services some amount. And so this is determining what margin you have on it. So if you earn $28 and your margin is 60%, then it's costing you $11 per month per location. And then these are obviously based on the price changes of the higher tiers. Same logic though. Um, so if you want to do it out again, you can see the revenue. Let's do the third tier. It's $85, and I'm paying $34 to the supplier. So I'm making a profit of 51, which is a margin of 60%. And you can see if I change this to, let's see, make sure this is the right one. If I change this to say 45%, now you can see this is now 45% or 20% or whatever. That's how that math is working there. And you could change these if they change over time. You have the flexibility to do that. Next is the general and admin. So this is I've allowed you to pick the start month, so you can pick any month in the 5-year forecast for a given cost to start. This is the monthly cost in year 1, year 2, year 3. I've added a little bit of logic, which I haven't done before. You can determine the percentage increase in cost per year. So this is saying, well, it's 8,000 per year in this year. Now it's 82, 85. So this allows you don't have to manually figure out this if you just want to say it's a flat percentage. If that doesn't apply and you just want to manually put it in, you can just override this formula here. You'll lose the formula, but at least you can just put in your number and it will flow through to the monthly detail, no problem. And I've just put in fillers here for how this works, it's my way of checking the logic to make sure it's all working. So these are happening 1 month in time in the future, and you can see they start in a staggered, like every month the new one starts. So that just allows me to make sure the formula is right. So those are the G&A expenses. I put some main ones in here, but you might have more or less or whatever. You can zero anything out that's not applicable. Then we've got sales and marketing. So you've got salesmen you're going to have to pay. their costs might increase per year as well. You could change the month that they start, marketing, website, whatever. You could define all of that here and it'll update automatically. Then we've got other costs, so income tax. If you don't want to try, you don't want the forecast to include any income taxes, this would be like corporate income tax. So you can just put 0% here, but you can account for it if you do put a percentage here. Um, you can put other costs as a percentage of recurring revenue. So this is saying of your recurring revenue, do you have any other cost of goods sold that it's irrelevant that you need to take into account? If so, you can put it here. We've got other costs per location per month. So this might not be applicable, but if it is, you can just put like, okay, so I know I got to pay X dollars per location per month, and it's some cost. This just allows you to take that into account there, and that flows into this here. Where's that flowing? Here. Other costs per location per month, and then credit card fees, service call, labor. So credit card fees, you can put a percentage of revenue that's paid with credit cards, and then what the credit card fee is. It could be 0%, it could be 100%, whatever it is. I just have it staggering down because obviously you want to pay less credit card fees over time. So you hope that more customers just do direct debits. Okay, so here's the other cost. I was just making sure that was there. So other costs as a percentage of revenue is that because it's part of cost of goods sold. That is in the G&A section, and this is in the G&A section. And just a note, from what I've researched, and no, credit card fees are not part of cost of goods sold unless that is the only way that customers can pay. If there is options to pay other ways, with how your infrastructure is set up, then it's just a general administrative cost. All right, so there's your cost, everything to do with that. Now we've got startup into Capex. So first thing, we've got inventory here. So this allows you to prepay for inventory, and it's 0 here because we're not even starting revenues for a while. But if we put this back to, let's say, February, you're going to get a cost here. So this is saying you'll prepay ahead of time for 3 months worth of your planned equipment costs. So this is just taking, if you look at your monthly, where's our equipment? Cost of goods sold would be right here. So it's taking the first 3 months. So month 1, 2, and 3, it's 156,000. So that's coming 154.8. Oh, that's total cost of goods sold. Here's the equipment purchases. So there's 154,800. So it's taking these costs and saying you're going to actually pay for those in your startup. Now you could put that at whatever amount of months, and it will change based on the values that are shown here. And then in the bottom of the cash flow, I do zero that out. So I add back the equipment costs, equipment purchases, and then I retake it out based on the schedule of paying every 3 months for inventory. And you can see that is right here. So you can see right now it's every 3 months. Now, if I change this to, say, every 5 months, now you can see they're spread apart every 5 months. I could do it even closer. I could do every 2 months. Oop. And there you see every other month. And the first 2 months are paid in year 0, but then we go forward. So this is paying for these 2 months. This is paying for this month of March and April. This is paying for May and June, July, August. And you can see the equipment purchase always equals, so that's 600. What is that one? Can't see. 6.1 million, 6,114,600. That will always equal your cost of goods sold equipment purchases here. As you can see, it does 6,114,600. And you can see the actual logic here that it's being added back in, and that's the actual timing of it. which those will mostly be the same except for the year 0 and year 1. These will likely just be the same. But that timing is critical so that you know like how much startup costs you need versus costs over time, and it's all relevant to when your revenue starts and everything else. So again, better, this is smarter strategic planning, or you can do more strategic planning with that logic available. Put it back to 3 months here. These are just other initial costs, like if you're going to buy a building, or let's say website creation, you got to buy vehicles for your service labor, signs, kiosks, furniture, whatever. These are just like one-time costs that happen, that you got to spend money on. And then we've got Capex here, which is similar to startup costs, one-time costs, but they're happening in the future, so you could pick the month that it happens and the amount. Now that's all of the main assumptions. The only other thing that you're going to have to know that you have to enter manually is the depreciation. So that's a manual item because I haven't set it up so that like I know, okay, if you put vehicles here, then these are going to be depreciated. But if you don't have anything here and you're renting, there's none. There's too many ways this could go wrong for the user. So I just put it as you're going to have to calculate um, what your depreciation is, and it will only matter if you're applying taxes. If you don't even want to worry about taxes, you can just zero out the taxes, and there'll just be no effect. Zero this out. There'll be no change at all in the cash flow um, at the bottom. But if you do, there's that. Now I did add a helper here, a depreciation helper. So you can put like if you paid this much, it's got a useful life for this. This is the monthly cost or monthly depreciation you can actually take off, and that reduces off your taxable income. So that might help a little bit. Now the next thing let's go over is, so now we've got all our assumptions. We know all the revenues that we're going to make. We know all the expenses. We know how much cash we're going to need. We know the cash flow in the future. So now we can look at distribution. So we know here, these are the sum of all the positive months of cash flow. And these are the sum of all the negative months. And you have negative months because of mainly inventory purchases. So based on knowing that and how much equity you have at the beginning to start, we can figure out the actual cash flow that's available to distribute, which is this line here. So what this line is saying, okay, investors and owners totaling are put in 1.8 million. They're going to get back here, even though they have positive months of 633,000, there's 466,000 of cash outlays. So that means of your remaining equity, you've only got 108,000 left. So you're going to have to use all of that plus some of the profit you've had of the 633,000 to pay for these cash outlays. So the actual available cash, this 275 is doing total in less the total out plus the remaining you have here, which after year 1 you can see that's going to be depleted. So at that point you're going to be only surviving on the cash flows of the business to pay for any cash outlays that you have, and that could possibly be still negative in the future. And in that case, you could have a negative year here where you actually have to pay out more cash than in the initial. But that's going to be really rare. It's just if depending on how your assumptions go. But you can see there that's 275, 321. So that's basically the calculation. Total in, total out, less any equity you have left, or any cash flow from equity. And if this is negative, then now the next year you're not going to be able to draw any of that. So this just keeps going negative. And the net 73 here, as you can see, that's just the net of these two. So you've got 794 in positive, but you've got this much in outlay. So the actual amount you can give back in a year is this amount. And it does that for each year, and it all adjusts perfectly and dynamically based on how you change the assumptions. So yeah, this is the smartest and most complete logic I've done for a contribution and distribution summary that can handle any possible um, cash flow scenario. Then here, just some standard, you've got the IRR of the project. So this is just taking the total IRR of the cash flow. So this is how much you have to put in equity. This is how much is returned over the 5 years. Here's the same thing with discounted. Then you've got the net present value, which is just taking the present value of all the future cash flows against the amount of cash you have to pay out right at the beginning. You can see if you take the IR and plug it into this, it'll zero out the net present value. You see there is zero. And now the same exact calculations are happening for the investor based on their assumptions on the control tab. So they're getting 75% of the distributable cash flows, and they're putting in this much amount, so their internal rate of return is this. And then they have the same discounted cash flow. They have a net present value here based on the amount they put out versus the present value of the future cash flows. So obviously that needs to be positive to make it worth it. And then you got the owner cash flows, which you might not always have an IRR here if you're not going to put in any money and you're getting it all from investors and or debt, and just paying that debt back whenever you exit. So, but you will always have a net present value, and obviously any cash flows based on the percentage of the company you're keeping, you get to make. So there's that. The executive summary is more focused on the revenue. So you've got your subscription revenue, you've got your installation revenue, service call revenue. Then we've got cost of goods sold, your G&A, sales and marketing, other costs, percentage of revenue for each of those. You get total expenses, EBITDA, which is earnings before interest, tax, depreciation, amortization, your margin, and then you've got other cash items. So this is where we're adding back in the equipment, but then we're reducing out the actual timing of that equipment purchases for the purpose of actually knowing what the cash flow is per period. Then we've got Capex, debt service, investor funding, company funding. So this is your owner equity, your investor's equity. Here's your total startup costs and your loan proceeds. And based on all of that, you can see here's your cash flow that you have available. And then you have year one happening, and based on all of these things, you can see this subtracts and adds all the right stuff. And you'll note the balance here, the running cash position is 7,182,000. That will always equal the distributable cash flow. So 7,182,000. And if we sum up these 5 years, you can see at the bottom here, 7,182,000. So those will always be equal to each other. There's no situation you could do that could make it not true, or else that would mean there's an error, which there is not, because I've tested it extensively to make sure it tracks everything right, no matter what kind of assumptions you plug in. All right, so that's the executive summary. Now the fun part, or the interesting part, the visuals. So we've got some nice visuals here. You can just read them as I scroll down, but just trying to show the overview of the forecast based on your assumptions. I do want to talk about this, the MRR, the monthly recurring revenue percentage by subscription type. So this really is a clear, shows you the change, and this is based on the upsells and expansion. So you can see you're expanding the high tier, the revenue you're getting from high tier, and the revenue you're getting from low tier is going down. So, and the reason why is because one of the reasons why is, well, that's going to be based on the percentage that you have of each location joining. And you can see the least amount of locations join high tier, but over time, we have these upsells going from tier 1 to 2 and 2 to 3. So these percentages are what drive how much this can overtake the lower pricing stuff. So if you look at that here, if we change, let's do extreme. Let's say in year 5, we've got 10% per month of customers moving from tier 2 to 3. So now the mid tier should be really small and the tier 3 should be bigger. Let's see. Yep, there we go. So you've got a big high tier and a little small mid tier and lower low tier. So that is how that's the effect there, and that's basically this going down is showing more people moving from mid to high. So that's a really cool visual. Super nice. You can see plug in these assumptions however you want and see the effects in that visual there. Next up, we've got cumulative location counts. So that's just a standard metric. We're just showing you how many locations you have over time based on the amount of locations added and lost. Um, we got annual cash flow, distribution summary, the actual amount of locations added per month, which is just based on those assumptions we put in. Installations per month per type, monthly change in MRR, installers needed by installer type, installation revenue, monthly recurring revenue, expansion. So this is another big metric. So this is showing you actually the amount of revenue you've gone up by from your upsells. So you can see here net we're adding about just over by October, by the last month of the forecast, almost $800 in expansion a month from current customers, and we're losing about just under 600, maybe 550 a month from people canceling contracts or downgrading. So the key here is to make your expansion from current customers, the revenue earned from that, be more than all of your churn revenue. And you can see in this case, based on our assumptions, it is. And the net between these two is shown here. So you can see this that the total expansion MRR is showing in here, and that's a little bit higher. That's basically doing this line, this top line here. And then this line is the churn, which is doing this top line here. And these are stacked charts, so it's showing you like the amount of each, like tier 1 cancel, tier 2 cancel, tier 3 is showing you the amount of the total amount. If you add them all together, that's the total churn. If you add these together, it's the total expansion. Um, and then this is showing you just the total basically against each other. And so that it's actually kind of cool. It's actually pretty symmetrical. I like that shape it makes, but that'll change based on whatever your assumptions are. But super important metric to actually track. Now for the resulting most important metrics I've done in a different color and different chart. So you've got this is your negative churn. Well, if you can get it negative, it might be positive if you have a positive net churn, then it's positive. But I just call it the real monthly churn rate. And your goal is just you want that to be negative. And if it's negative, it means your current customers are giving you more money each month than they're like you're increasing their monthly recurring revenue at a higher rate than you're losing monthly recurring revenue from canceled contracts and downgrades. So this being negative is really good. That's what your goal is. This is showing the net MRR expansion. So this is actually going to show you the result of these two subtracted. So your total expansion less your churn is going to be the difference in monthly recurring revenue that's shown here. So this is saying by the last month you're actually almost raising your monthly recurring revenue by $250 per month. And that's not including new customers. That's current customers. Then we've got your customer acquisition cost, which is just your sales and marketing divided by the new customers added per month. And then you've got your months to pay back your customer acquisition cost. So this is saying based on your average recurring revenue per location and the cost of location, how many months it takes to pay back the CAC. Now this is not including in this calculation, and I'll show you where it actually is happening right here. Months to pay back. This is not including the one-time installation revenue. So this is just the recurring revenue. The months to pay back would be a lot lower if we had the average revenue per location per month. We can't really do it here because it's only a one-time revenue, so we could do it here, but I just wanted to show just the recurring revenue effects. So that's what this is doing. Now, when we get into the average customer lifetime value, this is including the initial installation revenue plus the revenue from the amount of time they're expected to stay till, which is all based on the average churn rate over time. And then you can compare this customer lifetime value to the cost to acquire a customer. So basically this divided by this, and you get a ratio which is LTV to CAC. So this is saying, your lifetime value is 12 times more than what it costs to acquire them. So that's obviously good. You want this to be up between 6 and 8 is really, really good. Any like 5 is still good. Um, so that's it. Um, Now, if you, like I said, if you wanted to do months to pay back, if you wanted to include the one-time installation fee, all you would do is take the 282 here and add, you do double parenthesis here, you would add, what do we call them, G? You would add the installation revenue divided by the amount of locations. So it would be this divided by locations. Nope, where is it? Be the consolidated. Right here, 30. So it's saying that's how much you get for per location, and that equals divided by this. Let's close that parenthesis. CG 2282 plus this see if this works. There it is. So if you include the installation revenue is really low. Now one reason why you might not, and I'm not going to, is because you've also got the installation costs. So you're not really you're earning that revenue, but there's a lot of costs that come with it. Here, you're just saying it's the monthly recurring revenue is your basis. Now that you could get more advanced, you could go and say, what's my revenue less the cost, less your basically what's the gross profit, and you could reduce this cost here, so the 11, 20, 18, $34 a month with that. But that's now we're getting pretty subjective in the calculation. So you can do that, but I have not. I've just done it as the revenue earned divided by the cost to acquire the customer, and that's how many months it takes you to pay it back on the top line. Okay, so I think then this we already went over all this, so that's it. Now, like I said, you can use this for a regular SaaS business or a obviously it's tailored to a security system and alarm services, but the metrics and summaries here are very useful for almost any startup that has recurrent revenue. Um, so what I'm going to do is this is going to cost a one-time fee of $125. If you find any logical errors in the model, I will refund the price 100%. So just email me if you did, and I'll check it. I'll open the actual file that you were sent, and we'll go over it and see if there is. But that's how confident I am in all this revenue logic and all this stuff working. I know it's really complex. There's a lot of stuff going on. So you've got that guarantee. Um, and I'm also going to include this in let me do a new tab. I'm going to include this in the SaaS or the as a service bundle if it opens. Here we go. So if we go to smarthelping.com, This will be included in the as a service bundle here, and I'm not going to raise the price. This will be $289, but I'm just going to add this as part of the whole bundle because it's definitely fits in here. And if you want to buy the model, just check out obviously smarthopping.com or my other vendors. I also will sell this on efinancialmodels.com and Eloquence. All right, have a good one.